50-52 range will continue to spur exports. And as long as China's production continues to get, in a sense, hit by labor problems and the currency arbitrage, I think Indian exports can actually take off. So the recreation or the resurrection of the Indian manufacturing base as a story going forward for exports, a slightly weaker rupee in the 50-52 range, which will also bring in foreign capital, by the way, into the debt and the equity markets.
Jakes, what I hear you say is that unless and until some of these innovative, dramatic things are done by the government, are you saying that this market would therefore continue to remain fairly range-bound in a very narrow range unless something dramatic or innovative, as you called it, or some hard steps from the government actually happen? Is that what you're saying?
One is that, and two is if you look at who will be the buyers in the market, other than the FIIs, which have been pretty dominant in their allocation of money into India, the other set of people who have actually been buying are the promoters. Virtually every Indian and foreign company, whether it's the Alfa Lavals, the Siemens, the ABBs, the Atlas Copcos, or any of these Indian companies which have been, where the Indian promoters have been pretty active, you're seeing that the promoters and the founders are actually seeing a lot of value in their own stocks and are increasing their holding, and they've been the biggest buyers, whether the delistings which the Atlas Copcos and the Alfa Lavals have been doing, and the others who need to do this by 2013, or for instance names like Siemens and ABB, where at 30 and 40 Ps, engineering companies have been have been seeing promoters increasing their stake, 35, 40, 45 Ps. So I really feel that the confidence as far as the Indian markets and the Indian domiciled entities are concerned is very high from perspective of any of these players. What is lacking is some amount of policy tailwind, which actually can happen quite so easily. The government, in a sense, is paralyzed by its own inaction and its own lack of conviction, lack of thinking. But were it to get a few people to just brainstorm and suggest some of these are not very complicated ideas, these are quite simple, where essentially a show of confidence can get money back, and even the locals from actually, and if you see it even from April 1st onwards or April 2nd onwards, locals have not been big sellers. That's because the insurance companies, which were selling for dividend and other distribution, up to March 31 have stopped selling. So with locals not really being aggressive sellers, FIIs being at the margin buyers, why should this market do anything other than react positively to A, international liquidity, and B, some surprise announcements of the government. The worst, let me repeat, the worst has been factored in, and the markets could actually surprise you on the upside.
Do the valuations look attractive to you at this point? Would you buy at these levels, and what would you be buying?
Valuations across the board are reasonable. I don't think as an index the valuations are aggressive at all. The reality is that, as I said, if the founders and the principals can see value in their own stocks at whatever P's the markets are trading at, are at a small premium. In fact, the Atlas Copco and the Alfa Laval delisting happened at 3 times the price which they traded in the secondary markets when the announcement of delisting was first made. So people are seeing value at significant premium. The value across the board, sector specific, of course, from the way we look at it, because we are not a house that views the market in its broad context. But I suspect that across the board there is value to be had. Every sector is throwing up names, and today we don't want to talk specific names, but really speaking, I think in a market where the founders and the promoters are doing buybacks and increasing their holding, I have no doubt that some patience and use of capital into these markets will generate returns.
What would the themes be, Jakes, that you would play for? You would play for, the whole delisting, or where the corporates themselves are investing money? That could be one, because you mentioned across sectors. So if I were to just narrow that down, what would be the 1 or 2 sectors within which you're finding better stories? And secondly, what would the strategy or the theme be?
I think if you want to look at sector stories, really speaking, you've got to look at financials for sure, because I think the interest rate cycle has peaked. Foreign money will ensure that Indian interest rates don't remain at these levels, number 1. Number 2, as debt markets open up, more and more foreign capital will come in, and people will hedge out their dollar rupee exposures in a form that gives them net dollar returns of 6 and 7%, which is still very much possible in the debt markets. Number 2, so the financials is something that we are quite enthused by. Number 2, the infrastructure space, where reforms, especially in the power and the infra space. I mean, let me go back to a simple example of Delhi. Delhi, it's is well known as more cars on the road, which talks about the consumption theme. There are more cars on the road in Delhi than the other metros put together. What has Delhi done to address this? Roads are crowded, but over the last 10 to 12 years, the government there has actually dramatically changed the landscape, expanded the city, and Delhi's got the advantage of being able to expand. But more importantly, there are flyovers galore. Now, that's not happened in 3 months or 6 months the way it would happen in most in markets, maybe in many markets like China, etc. But it's happened in a period of time which has been slow and painful. It's been unsettling for the residents. But you look back over a 10-year period, Delhi is a completely transformed city. Traffic moves, there are flyovers, infrastructure is dramatically improved. I think that's the story. So on one hand, get private sector into the infrastructure space, so we like that. And while you do that, the consumption story will take off on its own. So go back to the 1992 mantra, reduce duties, continue to boost consumption, and while that is happening, the exports also take off because the currency is weakened. Please understand that in India, the labor market has evolved quite dramatically, and the labor market today is not just skilled, not just mass in number, but more importantly is able to take on the best competition in the world. So China has actually had problems. They've moved to a consumption model, more and more are moving to it, only because they feel that the labor unrest is something that they cannot manage this current regime on. And therefore, as they continue to jack up wages at almost 25-30% per annum, Indians will become more and more competitive. So the export space, financial space, infra space, the consumption theme where P's are not completely out of whack, these are the spaces that we kind of like.
We're done with FY12, Jakes, and we're going to see those numbers coming out very shortly. What's your sense of where could we close FY12? And more importantly, I know that's done now, but FY13, there are certain experts and broking outfits which have put out still very optimistic numbers, saying 15% is what we could see on the Sensex EPS. Where would you stand as far as FY13 is concerned? And more importantly, I also want to pick on that one point that you made earlier in this interview about the whole investment cycle coming back around. How important do you think is that? Because that's pretty much ground to a halt.
I think it will, the first steps I see have started. I believe the investment cycle will start off. Maybe second half of this year will be more perceptible than the first of FY12-13. As far as earnings are concerned, I'm not sure whether it will be 12% or 15%. That's not that relevant, but there are many companies which will do the 15-20% number on earnings, and they are trading very much at the lows of the 52-week range. And I think that's the kind of approach we'll take in the spaces that we mentioned. So my own take on this is that many of these power companies, for instance, have dropped 85% from peak and then bounced off maybe even 100%, but they're still down 65-70% from peak. The last bounce was more in completely oversold territory to a more normalized zone, but I think there's value to be had as a lot of unlocking takes place. I mean, whether it's stories in the retail space or stories in the infra space, many of these companies have put together assets collected during boom times, and these assets are valuable, but they could not continue the investment cycle into these different spaces. So the unlocking of value will come when non-core assets are shed, and that, I think, shedding process is already begun, and I think it will continue. A lot more PE activity, my feeling is, will focus on these divestments by corporations that have assets in different sectors. And I think that could be another restructuring story that could gather storm.
We'll leave it there. Thank you very much, Jakes, for coming by and talking to our viewers once again. Appreciate you taking your time out.
Thank you.
All right, let's take a quick break here on Market Guru.